John Paquette. I'm VP Solutions for TIS's US market. And so today we're going to talk about working capital, obviously, right? But we're really going to frame that up from the context of how having insights into your working capital really help with your cash management processes and your cash forecasting processes, right? So that's kind of the lens we're going to be analyzing this under today during the conversation. And cash management in general, huge topic for organizations. I think, you look across industry surveys, market reports, even conversations with peers, it's a top 1-2 type topic, right? Everybody's thinking about cash forecasting, cash management, how can we get better at this? A lot of that's driven by the macroeconomic events over the course of the last few years, creating a lot of unpredictability in businesses. So within your own customer base, unpredictability in how payers are going to pay you, supply chain disruptions causing kind of similar, outcomes in the payment space with a lot of unpredictability around AP, and then corresponding to all of that sort of throwing working capital out of whack, right? A little bit for a lot of organizations. So it makes sense to kind of have a lens on that. And then you look forward a little bit and you have rising borrowing costs, right? You have a looming recession. You have people really thinking pretty heavily about cash management and liquidity. How can I improve liquidity? That naturally draws people back to the working capital topic. Or am I efficient from that standpoint? Are there opportunities to, turn working capital into cash to increase my liquidity position, right? So that's really, I think, what organizations are thinking about here a lot today. And so we'll try to give you some tips about how you can leverage those working capital insights to really help from that standpoint, helping the cash management and forecasting process. But before we jump into the conversation, definitely want to introduce my co-speakers here today. So John, maybe we could start with you with an introduction.
Sure thing. Good morning, everybody. My name is John Kane. I'm a solution architect here at TIS. I came over during the Cashforce acquisition from the Cashforce team.
All right, thanks, John. And Yolene, maybe you could introduce yourself as well.
Thanks a lot, John, to invite me to this coffee talk. I'm very excited to be here. My name is indeed Yolene Brumonpré. I'm currently part of the TIS US Solutions team, but actually I was one of the first employees of back then was Cashforce. And I worked in various roles within product and customer onboarding.
All right, thank you, Yolene. As you guys can see, we kind of have a good mix of practitioner solutions, operational type experience, all the way extending down into the product and the actual technical components here as well. So should be a good conversation. We can bring in a lot of different viewpoints. Maybe we'll start with just sort of a general topic. I guess, why should Treasury really care about this? Why should they really care about working capital? It's obviously an area that touches a lot of different departments, but for Treasury specifically, what are the tie-ins? And I guess, from a very basic sense, if you want to understand cash flow within your organization, you need to understand the cash conversion cycle, right? That's a big, driving factor over how cash is going to move in and out of your business, right? But John, maybe we could start with you with some thoughts just in terms of, what Treasury should really focus on in terms of other process tie-ins.
Yeah, so I mean, when we're talking about working capital insights in general, it's going to have a big impact on your forecast, so that's a big piece of it. But you're also going to want to look at some of the metrics that make up that overall cash conversion cycle idea, which is things like DSO and DPO, right? So you can get a sense of when cash is coming in to your organization, when cash is flowing out, and when we're just to level set here, we're talking about DSO, we're talking about days sales outstanding, which is the average number of days it takes to get paid after a sale. DPO, days payable outstanding, when we're talking about how long it takes to pay your vendors after contracting. So I mean, those are going to be really important measurements, just to take two out of many, in terms of understanding your overall cash conversion cycle. But what I think is interesting is if you take a step back and look at it from the Treasury point of view, right? Often Treasury can act as sort of the eyes in the sky for the financial aspects of the organization. And I found in working with various Treasury groups, as on the software side, working with Treasury groups, is that they're often very educated, not just on the financial aspects of the business, but also on the operational aspects as well, because they need to understand where cash and finance intersects with how the business itself runs. So if we can put them in a position where we're putting a lot of, say, invoice data in front of them, right, in a tool, getting all of that consolidated into one place, throwing it up on the board and being able to look at metrics like DSO or DPO, now I think we put Treasury in the position where they can start making operational improvements. So let's just take DSO, for example, where, if we want to look at that on the company level, that's going to tell us baseline whether or not we have a problem. Is it good? Is our DSO low, which is good. That's good to know and good to report. Or is it high? And if it's high, we have a problem. We have challenges. I think the power then would be to look at DSO below the organizational level to break it out by region, by country, by entity, to sort of start to troubleshoot where are the lumps coming from in terms of the data itself. Same thing on the DPO side. So, if you could start getting that broken out and start isolating where the numbers look challenging, where we might need to remediate some things. Now Treasury can then go to sales teams or AR teams on the collection side, or they could go to procurement teams or AP teams on the payment side, and start to have evidence-based conversations around what's going on in this particular area, so we can make fixes and hopefully chip away at shortening or keeping steady the overall cash conversion cycle.
Mm-hmm. No, great points there. I think definitely, it's two factors, right? It's the data, like you mentioned, it's having that data, having the granularity around the data, and then ultimately what kind of conversations come about looking at that data, and sort of the way that Treasury can think about what other departments are doing and really impacting their business operations on a day-to-day basis. And yeah, I think the pandemic kind of jump-started this a little bit too, because maybe those that weren't super involved in the cash conversion cycle and talking to these departments on a day-to-day basis, suddenly things became totally unpredictable. Treasury was saying, where's all the cash this week? You know what I mean? And then they're looking at the metrics and saying, okay, DSO jumped from 30 days to 45 days. I think that's what it was. And then subsequently having that conversation with the AR team to try to figure out what was going on. And so I think that's why people have sort of become so familiar with this topic and really gotten into a place where they're ready to kind of take that to the next level and integrate it into their normal day-to-day processes as well. So maybe taking it from that standpoint, we know that the data is useful, but in particular, what are kind of the metrics that organizations should be looking at when they're sort of analyzing their working capital? And I guess more so, what does this output really look like? It goes from data to insights to hopefully ultimately actions, the way that it's presented within a business. And so, Yoli, maybe I can lean on you here a little bit from the product side to say, what are the metrics organizations should be looking at? What are the, systems that are in place to help facilitate this? And maybe even what's the frequency that businesses should be looking at this on?
Yeah, indeed. So yeah, in terms of the metrics, so typically working capital, that's a broad term, right? It can exist out of a lot of what we call working capital metrics. The most important ones, John, I think you already mentioned them. So like DSO, DPO, you have your cash conversion cycle, which all have actually direct impact on your cash, right? But there are also, of course, a lot of other metrics where you can look at, like typically you have also the weighted average payment behavior of a customer, or the weighted average payment behavior that you pay your vendor to. That's also a crucial factor where you can improve your forecast with that. Also, there are also some metrics that you can keep into account to compare how you are actually doing with your working capital. That's what we call the best possible KPIs, or the default metrics. So actually, you can compare your DSO with the DSO in a scenario that all customers should pay on due date. So it's a quite nice metric to really see how you are performing. But there can also be some, then more speaking in terms of reports, there can also be some more visualizations come in place and some more links between the forecast and the working capital. For example, we can have a counterparty dashboard which gives all the insights of one specific customer or vendor, but within the frame of a forecast transactions. So that's a pretty strong analysis in my opinion. Then maybe your question about the frequency. So yeah, of course, how more frequent your numbers are updated, the better it is for working capital insights and your forecasts, right? So typically, I would recommend that you have your numbers updated on a daily basis, but you can also look at them at the past. So it's quite, it would be quite beneficial that you of course also can see the historical evolution about that.
Mm-hmm. Good points. Particularly, I like the point you made around the format of the metrics. Like, it's one thing to have your working capital metrics, your DSO, your DPO, your cash conversion cycle, and those will obviously give you great trends in and of themselves. But then to actually have a tie-in back to the cash forecast, where you can say, how is this actually influencing what I'm seeing in my cash forecast for cash movements, brings it to a whole nother level. And the frequency you mentioned as well is something that definitely sticks out to me, and maybe it's a good transition point into what are the historical challenges that organizations have faced with this topic? Treasury, sort of tracking working capital metrics, making those tie-ins back to the cash forecast. I could probably speak from personal experience on this one where, I probably had a pretty heavy working capital analysis component of my forecasting process, but I didn't have technology to do it. So basically what I was waiting to happen was the accounting periods to be closed every single month. And then from the ERP system, extracts of the financial data to go into the financial reporting system. Then I can ultimately run P&Ls and balance sheets and manually calculate out all these metrics for working capital, right? And it's one thing if you're trying to do that at a consolidated corporate level, but if you're trying to get granularity, like you mentioned before, right, and try to do this at the actual business line level, that can be like 30, 40 different separate P&Ls and balance sheets that you have to then run, calculate to get those metrics out. And then, over time we did acquisitions as well. And then you get system complexity too, right? You have multiple different financial reporting systems. You're pulling these balance sheets, P&Ls out of to ultimately calculate these metrics. And that lends all sorts of problems. First of all, obviously the manual calculations, right? Just the amount of time that goes into that. You run into the quintessential problem of, you spend more time compiling the data than analyzing the data, and you're not drawing insights, you're not making good business decisions based on that, right? You're just kind of putting together a report at the end of the day. The other thing is, I was, as much as what I thought I was doing was sophisticated, I was probably using it a lot more for variance analysis, basically saying, hey, why was cash off track? Okay, DSO crept up, or, or DPO shifted down or something like that. And that's what drove the variances in some of my cash movements during the course of the week. But I wasn't using it for cash management purposes to try to, kind of project out how cash is trending in the more near term. And that's a good point about the frequency for you, where if you can only do this monthly versus weekly or even daily, there's a whole different aspect of how you can use it for cash management purposes. And then probably the last shortcoming that really stands out to me is the granularity, so even if I could get down to business line level data for working capital metrics, I couldn't get beyond that. So, if cash was off, I could point to a business line, hey, you guys, something happened over there, DSO is up, but I couldn't tell them why. I couldn't share that data. I couldn't have everybody looking into it and saying, okay, here's 3-4 payers that we have identified here that have sort of a bad trend in payer behavior, and let's go ahead and address that. There was no opportunity to really do that. So, I think a lot of that's probably solved in terms of what I've seen for historical challenges through some of the technology implementations that have been put into place. And I know I spoke quite a bit there, so I want to give you guys a chance to weigh in too. Anything you guys have noticed about just historical challenges with the way things have done versus, the more modern approach, I guess, working capital insights.
Mm-hmm. Yeah, I think during onboardings, we often notice that the calculations of working capital KPIs are not consistent throughout the organization, right? So that makes it much more challenging to really understand and compare these KPIs and get valuable information from them.
Yeah, and I mean, even knowing the metrics, I mean, I guess if you have a predefined set of metrics that are going to be calculated, you don't have to go and hunt and say, hey, what metrics should I be analyzing? So sort of the specialists have already told you from that respect. So
I agree. I think leading with the data is powerful, right? To get buy-in, because you're going to the operation to make changes, either to people and their roles, collaborating with them, getting the right processes in place, making sure the technology that they're using is up to snuff. You're really just meddling unless you could sort of lead with that invoice level data, like you said, John. The granularity will help you make the case, and get the buy-in to collaborate some and put some solutions in place, I think.
Yep. Agreed. Yeah. So I think we discussed some of the some of the problems historically with this process, but maybe we shift to what are the opportunities. Say you have a good process in place, you're calculating this automatically, you have good metrics to rely on. We've touched upon a little bit just the value of having that data for insights, for the Treasury department, and also the opportunity to share that more broadly and become more of a strategic partner within the business. But I don't know, John, maybe you could give us some hints on what might be some good opportunities to use this data.
Yeah, I mean, one thing that comes to mind is, we were working with a client years ago, a food production client in Europe, and they realized they had big problems with their working capital, and they wanted to sort of, reform the process. And what they were looking for was liquidity, and their treasurer at the time, his vision was that, working capital is the cheapest form of liquidity. So, we need to, get a company-wide effort here to start hunting it down. And that's what they did. They got together. I mean, really, think about cross-functional roles, of salespeople and procurement people and AR and AP and even plant managers and people like that. So, by being able to show everyone that data and get their buy-in to collaborate, to have solutions, you really have something that's grassroots that can be sustainable because it's being built from the ground up. I think that's a huge operational, opportunity to fix things and make things better.
Yeah, I agree completely. And it seems like it's one of Treasury's best opportunities to really, show strategic value in the business, right? Because if you're analyzing working capital, finding ways to get more efficient, you can meaningfully impact free cash flow, which I think is what they really did in that project, right? They really just sort of, yeah.
Absolutely. We even had another example as well, where we had another client, multinational, with hundreds to thousands of vendors, who when they started looking at the working capital insights, they realized that all these vendors were working with different groups within our client's organization and getting different payment terms with all of those groups. So they found that they're having that visibility allowed them to go back and standardize payment terms across 1,000 vendors. It resulted in estimated millions in savings. It's another big way that the working capital insights can impact the operation.
Yep. Yeah. Now, it lends an opportunity, I think, for a strong business case as well, right? So if you're saying, hey, we want to improve our treasury management or forecasting tools, right? It's going to help us create reports quicker. Maybe senior management doesn't necessarily see that, but if you say, hey, what we're going to do is we're actually going to be able to get better visibility into working capital, and we're going to actually be able to increase free cash flow, improve our liquidity position through some of these insights, that's a totally different conversation as well. So. And
yeah, it was a quick win. It was a quick win at the beginning of the project too, which helped them get more buy-in, as they move forward. Yeah,
organizational buy-in, definitely important. And then even like forward-looking, a lot of organizations, it's how deep can you go down this hole of, optimize from a working capital standpoint. There are companies that want to get insights, get optimized, and then when they get optimized, they want to get further optimized through like the use of supply chain financing programs or different payment instruments and things like that. And having these insights, it lets you go that much deeper in the process as well. So definitely a lot of value here for organizations, in analyzing this data. So speaking of data, and maybe this would probably be the last point that we end on here. Maybe we give people a little bit of a call to action here. If you do want to get started on a process like this related to working capital, what really are the data requirements to do so? Is it in reach for the average Treasury department to be able to instruct, the technical people about the extracts that they'd need? Can you do this without technology, or do you really need technology to digest this data and to provide the insights? And Yolene, I know that you worked a lot on the product side for a solution, so maybe I go with you for first thoughts on this particular point.
Yeah, right. That's actually an easy question. So it's the same data set most companies are already using for cash forecasting. So we are talking here about quite simple data requirements. Typically, we work with basic extracts of receivables and payables data of the ERP system. And so working capital is purely based on open and cleared items like invoices, credit notes, and reversals. But to get the best out of the system, it is recommended to have like a set of 1 year of history at least, just that we can see the historical trends and evolutions and so on. So apart from the more transactional data, we also need master data, of course. Then we are talking mainly about legal entities, counterparties, and FX rates. So actually, it's just a new way to use the same data as was already provided for cash forecasting. And maybe also during the onboarding itself, we do have a technical assessment where we share the exact data requirements depending on which ERP systems our clients have.
Mm-hmm. That's a great point. So it could be that a lot of Treasury departments today are already pulling this data in some respects to drive their payables and receivables, their AR cash receipts and their AP payment forecast already. So it's maybe not even a new data element for a lot of organizations to pull. It might be a little bit more of a granular data element depending on how you want to ultimately use it. But yeah, it's certainly within reach. And I think that's a good point too, to kind of marry those two topics up, because if you think about, what that does for analytical purposes for variance analysis, knowing that that data source is the same, that you're driving your forecast based on that, and then you're analyzing metrics to sort of see what the working capital and business, processes that are driving that are, it becomes very easy to tie those two together, do variance analysis, detect problems in the business, know why cash is off, and, sort of make those sort of assessments as well. So great point there. So with that, I think that, that kind of brings us to the end of our talk track, at least here in terms of the points that we're hoping to cover. We are very happy to stick around here and answer any questions that might have come up with from the group during the course of the conversation. So yeah, maybe we'll pause here for a moment and see if any questions came in from the group.
Sure thing. Hi, everybody. Yes, John, we did have a couple questions come in. And also, if you have any questions, don't forget you can add them in the Q&A box on the right. So the first one comes in from Tamara. In terms of working capital solutions, should I implement a forecasting solution first?
Yeah, maybe I can take that one if that's fine.
Yeah.
So indeed, the implementation itself, as already mentioned, it is depending on the master data and transactional data. But once this data is in place, working capital can be already added quite fast. So it is possible to set up working capital before or in parallel with cash analytics and cash forecasts.
Yeah, and I like the point John made a little bit earlier too about, there was a client, I think he mentioned, that was implementing both, but a lot of the quick wins actually came out of working capital insights. So it's, once the data is in, it can immediately be consumed and you can start drawing insights from it too. So it could be a good source of initial value for the organization.
Okay, great. Looks like we have time for were two more that came in. The next one comes in from Julian. What kind of role can AI or machine learning play in this process?
Yeah, I'm happy to take a stab at it, although you guys might want to as well. I think we've seen a lot of different solutions, pushing AI to various extents, right? And some of that can be, basic algorithms or basic business rule oriented behavior. I think that's the approach that we've taken historically here, because I think that's really what the market is looking for, is logic that's built around that historical payment behavior, both on the client side and on your side. So getting an understanding of how things have worked in the past, getting a sense of, specific clients are paying, on a delay, or if they're paying early, having an understanding of that historical behavior and applying it to current forecasts, I think is, a powerful sort of down to earth tool that can really help make the forecast more, more realistic in a sense. And, have there been discussions and clients in the past that have wanted to go the route of, neural networks and multiple algorithms and all that sort of stuff? Yes, there have been. I think that what happens, this is just my opinion, guys. I think what happens is, you might get the what, but it's tough to get the why. And I think, seeing the data up on the board, like simple things like consolidation and visibility, are going to tell a lot more of the story than the output from a formula. Just my take.
Yeah. I think there's a little bit of I don't want to call it an issue, but there's the terminology sort of factor. And when you talk about AI and machine learning as well, a little bit, like, I think when people refer to AI and machine learning, what they're saying is they want to get like a deeper level of insight to their data that might be available at like the surface level calculations. So, for example, within our working capital insights tool, we'll look at, payer behavior. So if you're expecting, based on invoice dates, for a cash receipt to come in 30 days after invoice, we look across and say, okay, historically, the vendor actually, or the customer actually pays in, 40 days or 45 days, and allow you to kind of apply that logic, right? So we give you that level of insight, but I don't know if we would necessarily characterize it as AI or machine learning, you know what I mean? Where other people might view it as being that. So I think it's always, it's with any new technology, it's always looking about the use cases, what you're looking to achieve, what you're looking to get from that data, what sort of insights are missing from, sort of normal data analysis techniques to be able to figure out the right place for it. There's definitely a ton of promise for it, but there's no way that AI and machine learning can be universally applied across all situations. And as John pointed out, it takes a ton of data to do it well, so definitely considerations there as you're looking at a solution.
Okay, great. And one of the last questions comes in from Lewis. And sorry, I don't know the context of this one, but who do you see as an end user of this data?
Yeah, happy to take a stab at that as well. Typically the you know, the treasury managers, treasury ops, you know, are going to be maybe the people putting, you know, the forecast together, which is going to give them access to the working capital insights. I think part of that question is really going to be, who do we give access to the data, to the visualizations, to the tables, you know, to the underlying data? Who do we give access to? And I think that you know, with the right tool where you can sort of roll up views or drill down views, you can sort of tailor it to any stakeholder. So if you want, you know, those high level summary dashboards across the whole organization that, you know, your CFO or your treasurer might, you know, consume, that's easy to put together. But, you know, at the same time, again, if you're going to the operation to make an evidence-based case, you know, that there should be some changes here to how we do things, you know, getting down to that lower level of detail is gonna be clutch. So you know, it's gonna revolve. I think Treasury is going to be the distributor, but stakeholders can really vary across the organization depending on how they're impacted.
Indeed, for like clients who had users of the FP&A team or AR, FP, supply chain teams, even controllers as well that are using the platform.
Yeah, I think those are the best implementations that we see too, are those that are expanding that data out to multiple people in the department. Like you can see the obvious use cases in Treasury. We've gone over them during the course of this conversation, but FP&A is often tracking working capital metrics as well for their own financial projections, for balance sheet projections and things like that. So there's a lot of value in having that data accessible to those individuals. Of course, the procurement folks are going to want to see that data, right? Where's DPO? AR users, where's DSO? There's a lot of value there, and it really provides for a nice, I guess, you know, single source of that data. To Yolene's point, a lot of people calculate these metrics differently, you know, and there's historical challenges, I think, in organizations and people creating really nice data reports and just keeping them to themselves and using them for their own purposes. But this really provides the opportunity for everybody to kind of get on the same page about metrics, how they're calculated, and make that data sort of universally accessible across the organization.
Great, thanks so much. John, I'll pass this back to you. And if you do have any other questions, please don't forget you can reach out to John, or Yolene directly on LinkedIn as well, or by email. So you can reach out to me, jennifer.nuttall@tispayments.com if you have any questions. And John, I'll pass it back to you.
All right, thanks, Jen. Yeah, and just want to thank everybody for joining the session here today. I hope you found the content to be interesting. You know, Jen already mentioned, but we're always happy to continue the conversation past this point. Feel free to email or reach out on LinkedIn. We're happy to have one-on-one conversations or even just sort of, you know, toss around ideas about how to solve particular challenges you might be facing. So, and also, John, Yolene, thanks very much for joining the session here today. I thought it was a great conversation. We hit on a lot of topics in a very short amount of time here. So, thanks again.